What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Has inflation peaked? Is the bear market over? What's next for gold, silver, and oil? Going to discuss all of this and more with my guest today, Crescat Capital Portfolio Manager, Tavi Costa. Today's podcast is sponsored by TradeStation and FTSE Russell. Currently, TradeStation is running a promo just for our audience. New users are going to get 50% off brokerage fees for the lifetime of their account using the promo code FUTRAFZT. I put that in the chat. As long as they open an account by July 31st. You can go to tradestation.com/Anthony to learn more. Are you watching the stock market, specifically the Russell 2000? The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 future symbol RTY and micro E-Mini Russell 2000 future symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. All right. My friend, Tavi, how are you, my friend?
Anthony, how are you? I'm doing very well. Thanks.
I'm doing great. Thank you so much for coming back on the show. I remember when you and I talked last time, I'm not exactly sure when it was probably just about a year ago. And I remember the title of the show was something about, is inflation coming like in a big way? We were talking about it, right? And you were way ahead of most people saying that inflation is going to get a lot worse than you think. And you were right. And we're going to talk about some things also today that I think maybe didn't work out as well. Maybe we'll talk about gold and silver as well, but maybe those trades aren't over yet. But the first thing I want to talk about, and I think that, and I'm going to I put this out there for everybody also, and if you guys are listening, just participate in this. Let us know what you think. Do you think inflation has peaked?
I think we're in a very similar setup that we saw back in the late 60s and 70s when we had three waves of inflation. And so basically inflation started really in the late 60s, developed all the way, made the very first peak. And then it came down a little bit. Then we had another inflationary peak in the mid 70s and then the late 70s. And I think we're seeing most of the first wave. I think it's quite interesting how CPI data is actually lagging, in my opinion, a lot of what's going on. I mean, first of all, it was lagging in 2021. In other words, very clearly, we've had a lot of leading indicators showing that inflation was much higher than it was being reported, and it is higher than what is reported right now. But my point is that I think inflation, if you look at the latest CPI print for June, I believe it was the highest print on a month-over-month basis since 2005. And I don't think in the last 2 to 3 years, at least, since we've seen inflation picking up, inflation's the June print should have been the largest. I think it was maybe March when we had the invasion of Russia in Ukraine. And so I think inflation is here to stay. I think we're in the inflationary environment, but we're going to go through waves, and I think we've seen most of the first wave. I'm happy to change my opinion on that if we see commodities trading higher again and surging to levels that we haven't seen in the last 3 to 4 months. I'm happy to change my opinion on that, but I do think that it's scary that the Fed is getting more aggressively in terms of the hiking and the tightening of monetary conditions, using those more lagging indicators instead of other things. And so I think the consumption of households in general is about to fall off a cliff. And that's what really concerns me. And I think that's the next articles and newspapers are going to be mostly about, in my opinion, about the rising fall of the consumer. And that's, to me, what's ahead of us.
Everybody, I asked the question to Tavi and all of you. Just put it in the chat, yes or no. Do you think inflation has peaked? I'm curious to see what you guys think as well. So, Tavi, I'm actually going to go to your Twitter account, too. I want to show everybody this, I think, as we're talking about commodities, we're talking about inflation. Let's add this to the stream and take a look here. You put this out the other day. You said commodity prices. Actually, you might have even put it out today. No, it was yesterday. Commodity prices adjusted for money supply is one of the most important charts in the current macro environment. Not the time to be shaken out of tangible assets. I think that feeds right into what we're talking about here. Talk to us about this chart and what we're seeing here. that you put on Twitter?
Well, I'm just absolutely tired of seeing folks doing analogies or using comparisons of 2008 with today's environment, which I think it's severely different. I mean, just from a capex trends that we've been early on using as part of our argument for what I think it's most of the cycles on commodities are predicated on long-term cycles of capex among producers and the larger companies. And clearly when we had in '08 was a peak of investments in infrastructure and other things, and especially merger and acquisitions that happened at that time. And today we're quite at the opposite of that. And so, and then you can add the political effort against, with the Green Revolution against the development of natural resource projects. And so, to me, we're at the beginning of a cycle for tangible assets. We're at the beginning of a time when you want to be owning commodities. And when you have, as you know very well, I mean, there's always new narratives that are going to be emerging as we get sell-offs in markets. And the new narrative is that recession will probably kill the demand for commodities. And to be frank, when you look back in other times in terms of the demand, implied demand for commodities, especially oil, it's not really that heavily impacted as a lot of people think it will be. It's in the COVID crash, it certainly was, but during other recessions like '08 and 2000, implied demand actually did not decrease as much as a lot of people are commenting about those assets. And so I think it's a lot more inelastic demand wise. And so the supply side, we know it's very constrained. And when you see cyclical commodities declining as they did recently, I think it's more of a reflection of how demand is about to fall off a cliff than concerns about commodity markets. And I've been in the camp of I believe strongly it's time to be buying the dip in commodities every time you get one. And here we are. We just got a dip. A lot of commodities have sold off significantly. Some of those are down over double digits. And so or over 20%, I should say. And so it's pretty clear to me that it's if you were a believer of the thesis that we are in an inflationary environment, and also we're misallocated of capital towards things like commodities. I do think we're about to see a transition towards that allocation. And again, this is not just a capital trend; it's also a labor trend where we've seen not enough folks really interested in geology and geosciences. And so we don't have a lot of folks really studying and becoming new geologists. And so this is creating a lot of inefficiencies in those markets. And so there's a lot of ways to capitalize on those trends in the near future.
Let's pull up some commodities and just take a look at the charts here just for some reference. Is there anything in specific you want me to put up, maybe an index, something that we could just take a peek at?
Well, I think copper has been, when you look at the signals in the economy, copper is perhaps one of the most important ones. It's been recently collapsed, right? And to me, we know for a fact that the supply side of copper is very tight. And so to see such a decline in the metal is a clear reflection of where demand is likely to be. And it's important. Just give you another way of thinking about this is I remember the pre-COVID times, there were no issues with labor markets, right? We didn't have a shortage of labor markets. This is all news to us when it comes to the shortage of folks working at companies. And companies, you look at job openings at record levels right now. Now, to me, this is more of an issue of the level of the stimulus that we saw from governments in not only in the U.S. but globally that really increased economic activity to levels that we haven't seen in the past. When you go and you deplete saving rates by about $5 trillion in a $20 trillion economy, clearly you're adding a lot of consumption, and therefore economic activity should surge. And that's precisely what we saw in 2021. And as you're coming out of a recession, you create those imbalances in labor markets. Now, that's not sustainable, right? And we're not seeing the same degree of stimulus that we saw back then. In fact, if you look at savings rates today, they're not at 35% relative to disposable incomes. It's closer to 4% now, which is actually close to a historical low. And so, those changes are actually a lot more important, because it's hard to believe we're going to have the same level of economic activity we saw in 2021. And so labor markets are lagging as usual. And I think we're yet to see those changes when it comes to precisely with corporate earnings. Mortgage rates increasing, you'll have saving rates declining, you'll have consumer sentiment collapsing. And so all those things, the dollar surging, all those things should have an impact on corporate earnings that should then feed into the problems with labor markets. And that's, to me, I think the economy is going to be in a very tough place in about 6 months from now.
It's so funny, Tavi, how psychology plays such an important role in so much of what we do with trading, right? When you look at where we were just maybe, let's just say, even a few weeks ago, where, inflation's running, super hot, right? You get everybody so worried about equities. Everyone's still thinking that, you want to be buying the dips in commodities. And then you have one rally in equities. You have a dip, obviously, in commodities. And nobody wants to be a part of what they thought was the right trade right when they get the opportunity to be in it. So like all of a sudden I see everybody's bullish equities, right? Everybody is bearish commodities, and inflation is peaked. It's pretty much over. Don't worry about anything. And nothing's really changed except the price movement in equities. It's, the equity rally, it's amazing how much it changes sentiment, but that's what trading is, right? I mean, we follow price, we understand that, but it is incredible to me how different the narrative is. And it's like, and I listen to you and you sit back, and that's why I like speaking with you. You look at it on the big picture and you think to yourself, okay, what's really going on here? You're not just changing it just in a second here. You're allowing this, you're looking at this whole thing at a much bigger view. And I guess really kind of brings me to the next thing. So obviously you're thinking that, I want to talk about two things here, actually. Thoughts on the rally in stocks, and with thoughts about the pullback like we're seeing in commodities. You think that these are just mean reversion moves and still what you think to be primary trends? Yes or no?
I do. I mean,
Okay.
it's important to, and some commodities may react differently, but I think your goal as an investor is to accumulate assets if they get cheaper. If you liked copper, 30 days ago, you should love it at these levels that you are right now. Narratives change over time, right? I mean, I remember coming out of the pandemic crisis, when we saw, especially to me, what was very telling was doing research, going back to the 1919 Spanish flu, and seeing clearly that the inflationary problem we had right after the pandemic. And to me, it was very clear that we're going to see something similar. But it wasn't as clear for other people. And one of the big narratives at the time was the money velocity. You remember that very well. Everyone was saying, well, money velocity is too low. How come you can have inflation? And that then shifted, and then we had inflation. And then the new narrative was, well, it's then, okay, we have inflation. Now it's transitory. And then it wasn't. And then it turned into, okay, we do have inflation. It's more persistent, but that's good for equity markets. And it wasn't. And then,
Exactly.
and then now you have, now we have a recessionary problem. And, I should say now everyone is back to the inflation camp, and majority of people would agree that we have an inflation problem right at a time when we may see consumer and consumption in general fall off a cliff, and that's where your focus should be. So, I mean, it's pretty clear. I mean, while I am in an inflation camp, I think the big story is going to be on consumption and economic activity and labor markets deteriorating over time, because we are in a vicious stagflationary environment. And, I don't know if copper could decline more. I have no idea. But, we buy businesses that we think are operate very well in this environment, and we think at these prices they are really cheap right now, extremely undervalued. And so we're back to energy companies. If you haven't built your position in energy company and missed the whole rally that we've had, the market's giving you another opportunity recently. But probably a lot of people will wait for another breakout to then add the position. So it is what it is. I mean, it's how markets work usually. So those changes in narratives are important, and I think there's a lot of new narratives today. They're going to be probably proven wrong, and so just like they were back in 2020, and some of them are concerns about commodities. I think are going to be another one. Now you got people getting into the dollar trend, the dollar trade in general. I don't think that's the time to be doing that. So those are my concerns. I think there's a lot of interesting setups here for to make money, and commodities is just one of them.
You mentioned that you think that we are in a vicious stagflationary environment. What typically happens in that type of an environment in the markets?
Well, wow, I love looking back in history, and I think there are a lot of good analogies: the 40s, the 70s, and the late 90s. Um, I think we're kind of in a mix of all those. The 70s, you've had, you can look back during the inflationary environment. So let's answer your question first. Inflationary environments where we had CPI above 6% for the entire decade in the median terms. And those were really the 70s and the 1910s. The 1940s, we didn't see that throughout the whole decade, but we saw a sporadic increase of inflation. But if you use the 3 decades, just for the sake of the argument here, the things that we saw those times was really real rates were deeply negative, and tangible assets outperformed financial assets. The difference of those times that we have today is that financial assets are way more overvalued than they were in the 70s, 40s, or 1910s. It would give you another reason to believe that tangible assets will really outperform financial assets. And so, to me, positioning starts there. I wanted to be long what I think are going to be, the most attractive tangible assets in the future through businesses or actual physical commodities. And I want to be hedging that position with short, what I think are going to be short opportunities in financial assets that I believe are very expensive. And so we're going to see a change in capital flows from one to another. That transition should also cause the ratio of tangible assets to financial assets to increase over time. And so to me, that's the focus. 5 to 10 years from now, and that positioning in portfolio will change over time. So now that we had such a big move in commodities to the downside, you increase your allocation in those. That's what we've been doing, and now we're seeing again the increase in equity markets actually appreciating. So we've been taking some action now too. Systematically, as the markets goes higher in financial assets in general, we've been increasing our shorts. That's our hedge of an inflationary book, and so to me that's really where we are. But it's important to remember. I think we're facing a trifecta of macro imbalances. We have the debt problem of the 40s, with the inflation problem of the 70s, with the valuation problem of the late 90s and the late 20s. And so the three imbalances really create real political constraints, and will put the Fed soon in a policy dilemma, in my opinion, which is, how much can they really sustainably raise rates to fight inflation over time? And the answer is, in my opinion, is they can't really do much, because the global economy and the U.S. economy really cannot sustain these levels of tightening in monetary conditions.
Well, that's going to bring me to my next question. What will the Fed do next week? What do you think?
I think the Fed will keep raising rates aggressively in between 75 and 100 basis points. I don't have a view, but I think we'll keep raising rates aggressively, because it's usually those guys are late to the party, and they're trying to aggressively tighten conditions at a time when inflation is already decelerating. And so it's going to exacerbate the what I think it's going to be the downturn in economic activity, and and so you know the tough part is that sure it's becoming more of a mainstream view, the recession risk, and so positioning becomes a little harder to make money on, especially with shorts, as we see shorts getting squeezed to the upside, and so it's been it's not very easy to position in this market right now. But despite those problems, I think economic activity seems pretty clear to me that we're going to see a significant decline because of those issues. And so I think the Fed at some point, and I don't know when, I'm very focused, and that's I think gold is going to signal that very well once we start seeing the real risk of a reversal or a pause in interest rates, in interest rate hikes. I think gold is going to signal that very clearly, and it's going to be pushing a lot higher. But gold was at all-time highs not too long ago, and I think we could see that again. But we've had such a severe level of reversal in terms of the policy stance of the Federal Reserve, from doubling their balance sheet and slashing rates to zero to now depleting their balance sheet assets and increasing rates to a degree that we haven't seen in the last 2 to 3 decades. And so, it's unfortunately no surprise that gold is getting hit in those
Yeah.
months. And so, but do I think that's sustainable? If you believe they can keep going here sustainably, then I think you want to be short gold. But it's just not my view. Over time, I think we're going to see uh, them walking away from those. And just one more point, Anthony. It's so important to remember what happened in 73, 74. Equity markets had to decline about 48% to really make inflation or CPI to enter a downward trend for 2 to 3 years until we saw inflation come roaring back again in the late 70s. And so, you know, I think we're going to have to see something along those lines to stop inflation. So, um, you know, tighten your seatbelts, in my opinion.
Explain the Fed mandate with the 2%. I'm not a macro guy. A lot of people always ask me about this. And you think that the Fed's going to continue to aggressively increase interest rates. And obviously, they have a mandate. And you've also mentioned how you believe that they are behind the curve there. Just talk to everybody, just explain this, I think, just in simple terms for everybody can understand how, at what point they would recognize that the Fed has achieved their mandate, and just talk to us about what that mandate is. It's 2%.
Well, the history of the Fed is that if they don't achieve the mandate, they change the mandate. So I think there's a
Exactly.
high probability, the 2% might be raised to 4 or whatever.
Yeah.
Um, and so I think there's a very big chance that may happen, especially if we have CPI at, let's call it 6%, and we start seeing an increase in unemployment rates, which is again a lagging indicator. But if 6 months from now we start seeing unemployment rates rise, or very real signs of deterioration in labor markets, they're going to be in a box, right? I mean, what are they going to do? And so they won't be able to tighten conditions the same way, and so it's going to be clear that they're going to have to either change their mandate or their messaging, and to the markets. And so that's yet to come. And I think, I mean, I wish they would be looking at a lot of the leading indicators, because it seems pretty clear that we're going to see a big declining. Right now we're seeing most of that in earnings releases coming from guidance. It's not really actual earnings collapsing or anything like that just yet. And we've seen most of this happening in real terms, right? So nominal terms we're still growing, but in real terms we're contracting because inflation is outpacing growth. Um, and a lot of folks are now also changing the definition of recession, because it doesn't fit their narrative to say, well, we've got 2 quarters of real growth contracting. We're technically in a recession, but no, we're going to change this because unemployment rate is too low, and now this is a better way to measure the technical term of being in a recession. So, no, just watch all those narratives, because they're
Exactly.
all, everyone's talking about those things, and I hear that all the time now, and it's hard to believe margins are not gonna contract, because inflation, at the very early stages of inflation, you see businesses passing that on to the consumer. I think that's the first step, and so you see a surge in earnings, and that's what we saw in the first quarter of, or the first 6 months of 2021. But then that doesn't last too long, because the consumer starts realizing that they're basically getting squeezed. So they start asking for larger wages and salaries. That's what we saw in the second half of 2021. And then with that, you have also interest rates rising. So the cost of capital begins to rise, and the cost of materials rise too. So companies begin to get a little bit squeezed. And so the growth in earnings begins to decelerate. That's what we saw in the second part of 2021. And then now in 2022, what I think it's ahead of us is that even higher amount of squeezes in margins, because wages and salaries should not stop from in terms of the pressure from consumers. And I don't think cost of capital will also relieve any type of major decline in terms of interest rates. And so if we have a severe decline of consumption, now we have now a large contraction in earnings as well. So to me, that's what's probably ahead of us here. On top of, you got tightening at levels that we haven't seen in the last 3 decades. So all those variables are playing into the same side of the equation here, which is I think a decline in earnings.
It's so funny that you mentioned how they're changing what what the definition would be of a recession. I have seen this multiple times on the news networks. I don't watch a ton of news either, but I've happened to be watching it. I think it was a Sunday. I was watching something, and somebody from the Biden administration was talking about, well, we're not technical. That definition of a recession, that's technically not right. And I'm sitting there and I'm like, well, it's one of those things where, that's not my cup of tea. That's not what I do anyway. But you are so right. And amazing how the Fed, they change their mandate. It's why the dot plots have been just the biggest joke of all time, really. I mean, they never truly follow them. They change their mandates. They're doing this, as we go. They don't know how it's going to end. And now you're seeing just trying to change what a recession is and all these other things. And it's scary to me because it's just trying to instill confidence into something that's just not there. We never let anything ever resolve itself.
Yeah.
That's what it feels like to me, and like I said, this is not my world. I'm just a trader, I'm more of a price follower. I follow guys like you to understand that stuff, but it's amazing to me that nothing ever lets itself get resolved. We just keep pushing things down the road and changing the rules along the way. And as traders or in investors, it's difficult because, if I don't bring you on today, I'll be the first to admit, it's like when I see the price action go up in stocks, it starts coming down in the commodities. You talk about copper, you're like, well, could the bear market be over? You just start thinking because the price actions change, but we lose sight of what's happening around us, right? And I've always told traders, you got to look beyond it. And what I'm getting from you so far is that basically nothing's gotten really better. Price action might have changed. And it's just part of what happens in markets, right? Nothing goes in a straight line. We are just in an area where we're rotating. And what we saw earlier in the year probably is going to continue towards the end of the year. And we're just in a pause or mean reversion type cycle right now.
Well, the box that the Fed is in is that, if there is any sort of softness as far as the message that they are delivering to markets when it comes to tightening conditions, um, you know, it's hard to believe, commodities wouldn't rally along with the overall equity market. And so that would, again, cause the issue with, then I would be wrong. I would change my view as far as we are in the first, still in the first wave of accelerating wave of the first, I'm sorry, of the first inflationary wave. And so I'm happy to change my opinion on that. I mean, I'm positioned for that. I actually kind of hope that happens, but it's not up to me. And it's surprising to see, still, back in the days, back in the 70s, if you look at earnings especially in the first wave of inflation, earnings contracted almost 30% during that time in real terms. Right now, if you look at estimates for the S&P, I believe just looking at 2 years ahead, they're expecting somewhere close to 35 to 40% increase, or 20 plus percent in 2 years, and about 15 or so percent this year. So it is severe, and I'm not sure we're going to see that as well. So I think nominally we might even contract growth as well. So yeah, I'm quite concerned about those, because I think the other thing has been, as traders. So just putting my trader's hat, you start seeing things become more popular. You want to fade those narratives. And one of the things that became popular in 2021 was inflation, but a lot of people didn't realize that inflation might be different this time, because it's a phenomenon that actually infiltrates an economy over time, and psychologically becomes a problem with consumers as they change their behavior. And so, that's precisely what's going on. I think the inflation gene is out of the bottle. And so certainly, you can talk to people, and people are concerned about prices going higher, and outpacing their earnings. And so it is, it's hard to believe we're not going to see this change in behavior again, with reduction of consumption as we go here. So I've been saying this a lot, because I think that that's the next narrative, is that rise and fall of the consumer, because I think the consumer is really at a breaking point.
We're going to take a quick 20-second break. We're going to come back and talk more about the rise and the fall of the consumer. And we're going to go to the gold, silver charts, and we're going to look at some of the things that Tavi is currently positioned in. Back in 20 seconds. Okay, we are back. And, Tavi, I want to talk about the consumer, because I think that this is such an important point you're making, because people think just because the market's gone up, or maybe some of these inflationary numbers maybe may come down, maybe they have temporarily peaked, or who knows, right? But people think that that's going to have just an immediate impact, and like all of a sudden everything goes back to being great. Now, the one thing I've learned as a consumer when I see inflation is that prices never come down as fast as they go up, and these things take they take they have long-term effects and impacts on people. It's just not something that just right away, just because all of a sudden maybe an inflation number has come down a little bit, that all of a sudden people are going to be spending more money and everything is just going to get better. I think that is foolish for people to believe that things can be turned off and turned on that quickly. Talk to us about what you see coming up, as you've been talking really a lot about, that you believe that the next thing that's going to that the market is going to look at as a negative is the consumer.
Yeah, and it starts with you've got a lot of issues right now, because it seems like we've got a very tight labor market. Job openings is still near record levels. And labor markets is a tricky one, because it's not only a lagging indicator, but you have to pay attention to the changes in the margin of those indicators. And we've seen one of the largest declines in job openings in the last month that we've seen all the way back to the COVID recession. We're seeing other issues with initial jobless claims starting to trend higher after hitting, I believe it was all-time lows, or it was continuing jobless claims that hit all-time lows, which usually is also a contrarian indicator. Usually when you hit lows, you want to be worried about those things starting to deteriorate. So you have technology companies already down for over 12 months or so. And if you're a CEO of a company, you start changing your tune. We have consumer CEO confidence now at a decade low as well. And so employment should start, waning significantly here. And so it's hard to believe that that's not going to have also impact on growth at some point, in consumption too. The other thing I would point out is that back in the 60s and 70s, one thing we saw is that we did see the three waves of inflation, but we also saw three waves of unemployment. And so, and that has a lag of about 1 to 2 years after the inflation problem deteriorates. And so here we are, 1 to 2 years into the inflation problem, and we should start seeing some problems in labor markets very soon. But it's going to be hard for people to grasp just because the narrative right now is so strong on the shortage of labor markets, and that shortage is just really dependent on the level of economic activity that we saw in 2021. So we're starting to see layoffs already in technology companies, the very large companies, especially the big tech companies in general are completely slowing down their business plans. And so now I'm paying very close attention to most of earnings release here, because I think you've seen investment banking businesses decline, some of them over 50% year over year. So those are very big declines. I mean, those are, you should be paying attention to this, because it's going to have some ramification to other parts of the economy. So yeah, I'm corporate bonds is another part of the market that is starting to show issues. Most of the issues in the markets have been really pricing in duration risk and not really credit risk yet. So we haven't seen the credit problem really be priced in markets in general, and we haven't seen much of the even the potential decline in cash flows that can actually cascade into re-rating of equity prices and other risky assets. And so I think that's yet ahead of us as we see the deterioration of fundamentals that then causes issues in labor markets, and obviously consumption is going to be at the top of that.
Yeah, no, I mean, I agree with you on that. I mean, like I said, I'm no genius, but I could see that coming. And next thing I want to talk about is crude oil. And you put this tweet out the other day, and I'll just read it for everybody. In case you think the selling pressure on oil is solely driven by recession fears, the U.S. government just sold another 27 million barrels of oil just in the last month. At this pace, strategic petroleum reserves will be zero in 18 months, completely unsustainable, and will end badly. I remember seeing this tweet. I'm like, this is kind of crazy. Talk to us about this.
Well, it's probably one of the most erratic energy policies we've seen in many decades. And strategically speaking, I mean, at a time when we have political risk at probably all-time highs right now, or I should say at a 50-year high, because we haven't seen this level of geopolitical concerns in many decades. And so I think it's a very problematic from again a strategic standpoint to be selling those reserves. But also I think markets are actually understating the impact of that in oil markets right now. I mean, if you're selling 27 million barrels of oil in the markets right now, I mean, obviously that's having an impact on oil prices. Now, is that sustainable is the question you need to ask yourself. And oil markets remain very tight in terms of the supply. I'm much more involved with mining, and I can speak much better about mining when it comes to supply. But the oil side of things is also very concerning. And so, and the geopolitical environment is certainly just adding to that problem right now. So I think it's gonna take a while for us to see those big changes in those markets. And usually usually energy cycles are much shorter than other metals and other parts of the commodity market. But because of the political pressure here, it's maybe we might be onto a little longer cycle than usual. And so I think this is very different in '08. And it's going to take a long time for us to see capex trends increase significantly from here.
I pulled up a chart of crude oil here, and really you could look at this in obviously two different ways, right? I mean, depending on how you want to look at a chart. I've always said that you could look at a chart, a person's point of view could be very different just from looking at the same chart. You could say, wow, we're still in this massive bull market, or you could say that crude oil is topped and we've been trending lower since. We've had lower highs and actually lower lows as of now. So for me, actually, it's not a market I've been super active in lately because I think it's just difficult to identify trend. When I see this, I feel like the macro backdrop is still bullish, but nonetheless, it's just been trending lower, so it's a difficult trade. With everything that that's going on, everything you've been talking about, and like we said, everything's just kind of mean reversion back. And even with that last tweet you put out in crude oil, does crude oil still have this underlying bid? Is still the worry still that we're going to see a big spike in crude oil, or are we just maybe even just range bound or potentially heading back lower from here?
Well, it's hard because the sentiment was just so bullish on oil in
Yeah.
general. It kind of needed a shakeout. Even my grandma was talking about oil, so there you have it. And But to me, it's hard to believe we're this is the end of a move just because, um, again, if you see a big change in production, we know production is well below what it was at the pre-pandemic highs. We know economic activity is much higher than that, and so I'm not sure. I'm not sure this is really signaling at the end of an energy cycle. I mean, this is to me just looks like a pullback in the middle of a move. I mean, don't get me wrong. I mean, we can see larger declines. People take a lot of leverage on those trades, and usually you see, it's kind of necessary to see things get cleaned up a little bit. And so here we are. But and a lot of the concerns from the Russia and Ukraine have somewhat, uh, you know, I would say not as big as they were, 3 months ago, even though the issues have not been resolved and things are still happening there. But I still think that it's, you know, I, I mean, I've been buying energy. It's incredible that now you have companies trading at 9% free cash flow yield. Again, I've never seen a market being a peak with a 9% free cash flow yield. Usually that marks, the beginning or the middle of a bull market. And I think this is more of a middle part of the bull market to me. And um, we've been allocating capital. I mean, you can find companies trading at 10-15% dividend yields today, with a lot of potential for growth in terms of the price change. And so it's it's a very interesting environment right now. I mean, we've been adding to some of those positions, and I think there's a lot of opportunities as well in emerging markets that are, I think, neutrally positioned when it comes to geopolitical stance, and I think there are opportunities there as well, and very similar to what we saw coming out of the 2000 recession with the tech bust. When we had declines in equity markets in the U.S. and sure, emerging markets did get caught up on those downturns, but um, not as much as you would think, right? I mean, they carry a larger risk, so you would think that they would get crushed during those times. That they actually didn't. They kind of held their ground better than developed economies, and I think we're seeing something similar right now. And I think when we have kind of the blue sky ahead of us, I think emerging markets are going to lead the way in a very significant way in the next years ahead here, especially the ones that are commodity driven economies. Brazil being one of them.
Let's go over some of those names. Maybe I'll pull up a couple of them on the chart.
I think Petrobras is interesting. I mean, it's trading at very cheap levels right now, and it carries political risk. So there's a reason
What
for that.
symbol is that? I don't know this symbol.
PBR,
PDR.
like the beer.
Oh, PBR.
Yeah.
Why it's all because I got that's why I couldn't see it. PBR. Okay. Right there.
Um, that's just one play in Brazil. It's um,
Why do you
uh,
like this one?
oh, I just like the fundamentals. I think the refinery business is is the largest in Brazil. They basically have a monopoly, and it may have issues politically here and there. I mean, I think most of the political issues in Brazil are priced in. I like Brazil because I think it's been ahead of the curve when it comes to inflation. It's been one of the few economies that have raised interest rates, or central banks that have raised interest rates drastically in response to the inflationary problem. And so, as we see developed economies catching up to that curve and hitting a wall, once they hit a wall, I believe we may see emerging markets really do very well. So I've been accumulating some of those of companies in the emerging markets. I think Petrobras falls into that category. I would say, no, I'm not an energy expert, so I have a large basket of a lot of liquid names. I like AMLP with most of the most companies that actually a part of the ETF. They have a very large dividend yield as well. We used to be short those companies back in 2014, 2015, because they had very negative free cash flow balances with very large dividends. Today, we're quite the opposite. They pay very large dividends, but they make a lot of money. And MLPs are a structure that is attractive to us just from a valuation perspective, and also fits into our macro views. I like to own most of the large companies from ExxonMobil, Chevron, and so forth. We have positions in all of those, and we love to own the E&P companies as well, the exploration and production companies. But again, it's a very different play than mining, because we own most of the large businesses that have more established free cash flow generation kind of companies. And I think the play is very different than mining, just because of the length of the cycle and the clear push against oil companies in the future may actually come to fruition at some point. And so it's hard for me to take a stance of buying very illiquid small cap companies in the space. And so I like to be liquid. And but it's a macro play where I do think most of the energy companies will do better, will continue to do better than the markets.
Let's move on and talk about gold and silver. Obviously, you and I have talked a lot about gold and silver in the past. I read a lot of your stuff on it. It's obviously no secret. Anyone that follows you knows that you really are, been and have been gold and silver bull. You talk a lot about it. With what you're seeing right now, with everything you talked about, what are your thoughts on gold and silver now?
I think we're getting close to a big change here in terms of policy stance, and I don't think we're there yet. But I think we're maybe in the seventh inning of hiking and also tightening cycle. And so, we've had I think the dollar looks mostly overextended, especially short and medium term, relative to other currencies like the euro and the Japanese yen. And so there's a chance for that to have some relief. I think we've had a big change in interest rates that also has been very important. And I think the biggest signal to me is yield curve inversions. I just posted right now that about 53% of the Canada's yield curve, and if you look at all possible spreads in all yields in Canada, the trade, you can see that we have about 53% of them are actually inverted today. And that, compared to other times in history when we reached those levels, it coincided or preceded to significant declines in economy. And so it's hard to believe we're not going to see something similar here. I think the credit markets are starting to to express their views very clearly, and so that's why we're seeing a lot of those inversions. And I always thought it was more constructive to look at inversions in a different way, rather than picking and choosing spreads, just looking at the entire yield curve and seeing how many of those spreads are inverted. And why am I talking about this is because yield curve inversions, when you have very large of degree of inversions, usually that is also linked to economic weakness and fragility in the system that usually tends to cause the Federal Reserve to either pause or reverse its policies that are usually aligned with tightening policies that tend to reverse or be paused. And so that should be positive for gold. And usually, those inversions are also linked to big appreciations in gold prices. And so to me, it's time to start looking at those, because it's and we've been allocating capital mostly in small cap companies, because to me that's really where the opportunity lies ahead, is buying companies that I think are going to be world class discoveries, and they're trading for very cheap multiples, because the market simply does not understand uh, the the industry very well. And so when you see a very high probability of success in exploration being priced below 20-30 million market cap, on something that could potentially be worth billions of dollars, I mean, it's kind of a no-brainer to build a large position. So we've been acquiring 20%, 10 or 20% stake in most companies that we think are going to be, in that position in the following years. And that's, to me, that's really where it's kind of like buying a ton of call option in gold. But not only gold, it's not only linked to gold prices, but also linked to the success of those companies in terms of their exploration program. So it's a long answer, but yeah, I'm very bullish as usual on precious metals. It's kind of a static position to me in the portfolio. I'm always looking for different ways to add to that position, and it's actually been doing very well despite the decline in gold prices and decline in miners. The miners are down 50% or so from their highs, I'm talking about the junior miners, the GDXJ ETF, and our portfolio is still up about 100 and close to 150% since those levels. And so that's mostly because of those success discoveries that we've had over the last 2 years.
I'm actually going to pull up. Somebody made a comment about something about an SGD. I don't know where that ties into. Somebody said props with the SG. Also, it's a gold corp, so it actually worked out. I didn't know the symbol.
Well,
Um,
SGD, just for people that don't know, is probably onto uh, what we think is probably the largest gold discovery in North America of the last decades. And so, this company is basically um, have a lot of optionality, which is why I love it. We own, full disclosure, we own over 20% of this. So, it's a large exposure for us, and 20% of the company. And so, clearly we have a view about where this is going, and we think this is going to be, they're going to be putting out results hopefully soon. I don't know when. I know that most of the drill results are in the labs, but I don't know when they're going to be putting those out. And we're very optimistic that they're going to, you know, that we're probably onto, a multi-million ounce deposit of very economically viable in the Yukon area. And not only that, I mean, there's optionality of owning other properties and other projects that are also just as interesting as this one. So basically, you're just seeing the success of one project really coming to fruition right now, and there's a lot more to go. So it's a very well run company, and just one example of something that we have done very well investing over the last years.
Very interesting. Thank you for sharing it. I want to go to silver because we're pretty much almost out of time here, and then I'm going to let you actually answer this question that Christopher actually put out, talking about kind of coinciding with the SGD. He said, once inflation goes above 5%, it has never come back down without the Fed funds rate exceeding the CPI. I think he says this is what Druck said.
Yeah.
Would you agree or disagree?
I think, well, I agree with the fact because it is a fact. Now, do I think the Fed will be able to chase CPI rates? Um, I would say no. I actually think um, I actually think the Fed is much more in a box than a lot of people think. I think if we see rates go up to 6%, for instance, I think we're going to see a major decline in equity markets until we get there, and it's hard to believe that wouldn't cause the Fed to pause those rate hikes in the middle. And so, um, we're just seeing, um, so far we've seen from the lows, Nasdaq was down somewhere close to 30%, 34%, I believe. S&P down a little over 20%. So we haven't really seen the true damage, even though you also seen damage in the bond market, in corporate bond market too. So treasuries and global bonds, fixed income in general has been coming down along with equity markets, which is kind of interesting from a popular portfolio positioning perspective, because everyone is long the 60-40 types of portfolios. And so to me, if we're going to go there, I think everything is going to collapse. And so I don't think I think the Federal Reserve and central banks usually always go back to the inflation route. And at some point here, I don't think the trifecta of macro imbalances were not the case in the 70s, the 80s, the 90s, and 2000s, and so and they are certainly the case today. And so I don't think we're going to see that. And so I'm not that I'm betting against that. It's just, if you ask my opinion, I think we're going to see a different setup this time, where actually the Fed is going to have to not raise interest rates above CPI this time.
Interesting. Last thing we'll talk about is silver. A lot of people talk about silver and gold together, although they are two very different things. Are you feel the same way about silver as you do in gold, or just what are your thoughts on silver?
Boy, I mean, I love silver. I think silver remains. I don't change my opinion there, because it's gotten cheaper recently, and still is a very attractive metal in general. We know the supply proposition is very constrained in general. We know that the demand for solar panels, especially, should increase drastically in the next call it 3 years or so, especially coming from China. And it's a monetary metal that should also benefit from increase in gold prices here. And so silver tends to surprise people in general that like to look at technicals and so forth. And it's just a brutal metal to trade, because it just does exactly the opposite than you think it's going to do. And so I think the best way to do it is to own. We're basically chasing what we think are going to be the largest silver deposits in the world, and what we think it's really leveraged to silver prices from a price perspective. And so, you asked me about gold just now, and if you look at the gold to silver ratio, I mean, it's just at levels that we've truly historic right now. So it's a time to be allocating capital there, and it has been the time for maybe 2 years or so. And I don't think it's time to be losing focus. And so we continue very focused on that. I think green revolution silver is going to be a critical metal here. In fact, it is considered what they call a critical metal too. And so it fits into the green revolution agenda very, very much so. But hey, if you start seeing things like snowline gold, the SGD that you were looking at, the chart, types of discoveries in gold, that might push the price of gold down. I'm actually not joking.
Yeah, well,
I
yeah,
mean, that's
a true supply and demand situation.
That's a supply and demand situation, no doubt. But I'm obviously joking that that's not the reason why gold is lower. But I kind of hope that I'm right on this at some point.
The only question I have for you before I let you go about the silver is I understand everything you're saying, but it also I'm wondering if we have the slowdown that you think it's going to have with the consumer, how does that really push the demand for silver going forward? If all of a sudden everything is going to be slowing down, we're in a recession, doesn't it kind of work against it in a way?
Well, it could, but it's important to remember 1973, 74 when we had that crash in the stagflation environment, going back to your question about how assets performed during those times. And I think a lot of us are just going back to '08 and 2000 and not really, looking back further in inflationary regimes and seeing how this really plays out. Because most of the times, especially during those times, silver actually performed very well. Miners actually went up fivefold while markets came down about 48%. And gold performed very well too. So you know, it's tricky. Do you
Yeah.
really want to bet, short silver, knowing that that's exactly precisely what happened during 73, 74. No, it's not my play. I think silver is extremely undervalued today, especially relative to other inflationary times in history. And so, at some point, I think we're going to see a major appreciation of the metal. It's just, you know, I think we've seen a big change in in, uh, in the Fed policy stance as a whole that probably had a big impact in silver. I wish I had that thought, a year ago, but here we are, and I think my job as an investor is to identify long-term trends and take advantage of them if I think they're cheap, and being able to buy. We're looking at buying, acquiring a silver asset right now that is a producer that is trading basically at one time, free cash flow. I mean, what an opportunity! One time free cash flow. I mean, annual free cash flow. Companies making over $400 million in free cash flow. There's not a lot of opportunities like that in the markets today. So, also on top of a major silver discovery, and it's still a private company. So, this is the type of opportunity you see in markets like this. And so I'm very excited. I'm just fully full. While people are worried about the silver price and so forth, I'm just taking advantage of it. I'm trying to buy as much as I can and being as smart as I can before a big move. And so, because I think it's inevitable. And once that comes, I think the people that are very well positioned and accumulated assets over time are going to do very well. So that's really my goal. It's to accumulate properties and companies that I think are going to have major discoveries in the future, and producers that are trading at very cheap levels. So if that answers your question, I mean, that's really where
Yeah.
my strategy is.
Yeah, well, no, I love your work. I love the confidence in your work. And to me, that's why, I like to talk with people like you to understand what you're thinking. You're never telling anyone what to think. You're always teaching us how to think, and really clear explanations as to why you believe in what you believe in. And once again, I can't thank you enough for your time. It's always great to speak with you. Let everybody know where they could find you on Twitter, and give everybody a website to check out.
You can look for my work at Tavi Costa on Twitter, or Crescat.net is our website where you can find letters and so forth. And for people that don't follow your work on Instagram, I see you every now and then. I'm not on Instagram all the time, but I see you on Instagram. You put out some really good videos. Congrats. And it's very high quality stuff, and I wish more people would watch it. So yeah, follow Anthony there as well.
Thank you very much. Jen, who helps me with my Instagram. I'm more of a Twitter person, and Jen helps me with Instagram, and she does a fantastic job. So,
Yeah.
Jen, it's a shout out to you. Thank you guys so
Yeah.
much. And like I said, Tavi, I'm always learning something from you, and you slowed me down right now. It's funny. I look at the price action, I see things. I like to talk with you and I don't always like to. I want to be proven wrong. Like you always say that as well. You say, I'm happy to be proven wrong, but this is what I see. And just hearing from you today, you slowed me down, understood once again the macro environment that we're in, understand that not a lot of things have really changed, and you gave us some good things to look forward to know if the environment does change, what things we should be looking at. So thank you so much, my friend. Enjoy your summer. I think we're going to hopefully have some quiet downtime in August. I think after this Fed meeting, and maybe a little bit of time to take off. So if you are doing that, I wish you all the best. And thank you again so much for your time, my friend. I really appreciate it every time.
Well, thanks for having me. I really appreciate having a conversation with you. So thanks.
All right, everybody. Have a good day. I'll see you guys live again next week. See ya. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.